So it means, let's say for example, this is my rate of interest at which I will borrow the loan. Okay, interest rate. So sometime what business will do, you will borrow the money and you will check what is the rate of interest, right? And if the rate of interest is low, we'll borrow the money. If the rate of interest is high, sometime we postpone our investment. So it means we are raising the capital through loans, or we are raising the capital through debentures or different debt instruments. So here what we can say, again, your whatever you're borrowing the money, we can put it for investment. So can I say investment once again is depend on your interest rate? Is it clear?
Yes.
So it means what? Can we write third equation? What will be my third equation? Investment is once again the function of ROI. What is ROI? Rate of interest, which is nothing but the rate at which an individuals or a person or banks or any kind of business is borrowing the loans. So that is also one kind of investment. So we will write this as equation number 3. Is it clear?
Yes.
So three equation we arrived. We arrived first equation what we derived here. Investment is a function of savings. Investment can be the function of income also, and investment can be the function of ROI. So it means if I combine all together, if I put it in one, so one common factor is your investment, and there are many independent variable I can consider for your investment. So which is saving is your first independent variable, income is your second independent variable, and ROI will be your third independent variable. Is it clear, everyone? Am I clear with the concept?
Yes, sir.
Shall we proceed? Okay. Next one. Now let's discuss what's now we derive with what is investment. Okay, it's a investment is nothing but today's sacrifice for future expected cash flows. And this investment comes from your savings, because savings turn into your investment. Then we derived one few formulas, what is independent and dependent. Let's comes to this next concept. What is price? Okay, I'm coming to now the concept of investment management through portfolio. What is price basically? The price is nothing but the price. I'm talking about price of a stock. So price of a stock is what you pay to buy or to sell the assets in the market. First concept. What is price? Price means I'm talking about a stock. I'm taking as a stock, or we can say share. It is a price what you pay to buy or to sell the particular asset in the market. This price has multiple names. This price can be, first one, it can be called as market price. Second one, it can be called as, from this market price, we can arrive with market value. So price has its, we can also refer as price as market price or market value. That is your price. Is it clear?
Yes.
Yes.
Okay. Now let's imagine this is financial times. Okay. You can just search any companies which you want. You can. Okay. First of all, you can. How do you go this to the website? You can directly go through your. Okay. I'll first introduce with you Yahoo Finance, and then we'll go to the next one. Okay. When we'll start in Excel sheet, all of us will work together. Okay. So let's take, we'll take Wipro NS. Okay, what is this? Wipro Limited dot NS. So what is the price of the Wipro? We say it's a price, right? What is the share price? So what is the share price of Wipro today? 465.80. So we say the price at which 465.80, this is the price. What we'll do, there are two people, one is the buyer and one is the seller. So buyer will buy, which is nothing but he has to pay to one share of Wipro, or we can sell one share of Wipro in the market at a price of 465.80. This is one share price of Wipro. That is the price. And that price is nothing but this is the market price, which is nothing but how much? 465.80. And today, if you want to calculate from this market value, we can also calculate the market value. To have market value of this stock, it's nothing but you require a price for that, which is also referred as what? Market value. So that is the price. Is it clear the concept of price?
Sir, what did you say for market value?
Market value is nothing but, let's say for example, what is the price and what is the value we are deriving from one share. So it's nothing but what we are paying for the particular share. One second, sir. I will admit one. So what is market value? It is a value. Today's value of Wipro is how much? 465. One share value is how much? 465.80. Sometimes we say value of the stock. Sometimes we say market price of the stock, which is once again based on the demand and once again based on the supply. That is your market value of the stock. The same share, if I take into the market, what is the value I will get? Which is equivalent to 465.80.
The market price is also same, you mean?
Yeah, market price means at what price you will buy or sell. What value you will get from that price, it's nothing but market value.
Okay.
Is it clear?
Yeah.
Shall you go to the next concept? Other participant, is are you clear with the concept? What is price now?
Okay, sir, I will proceed. Yeah.
Yeah, sure. Next one, let's discuss the second concept. What is written? Let's first talk about the concept of return in the terms of definition. Return is, or we can say return refers to the amount of money you make from your investment expressed in percentage terms. Okay, what is return? When we talk about returns, it refers to the amount of money you make from your investment. And how do we get investment? We have different ways of doing investment, which comes from savings, it comes from your cost of capital, it comes from your income, that's your investment. And from that investment, whatever returns you're generating, it should be in the form of money, but we express in percentage. That's your return, because returns always express in percentage. That is your returns. Is it clear?
Yes, sir.
Let's talk about this one. Now here we have just now visited. Now what we can say? Plus 0.98. Okay, let me take the same company only, Wipro. Here we have already visited the website. 0.98. So what is this 0.98 in bracket? What is 0.98 percentage?
Today's return.
Today's return is how much? 0.98. It means, how did you got today's return? Because today's plus, it's plus, right? It can be three colors, plus, right, or it can be black also. So what do you mean by plus? It means from yesterday to today there is a gain, means there is an increase in price, right? And how much returns you have made? 0.98 percentage. So we always express return in the form of percentage. So it means returns of Wipro, today's returns of Wipro is 0.98 percentage. We say that's a average daily returns. Okay, that's nothing but your average. For a while we assume that this is average daily returns of Wipro. And how much it is? 0.98. So let's say if you invested 100 rupees in Wipro, okay, so it means 100 into how much money you can make? 0.98 percentage, which is nothing but how much rupees? 0.98. So that is your money you're making from your investment. That is your returns. Is it clear?
Yes.
Others participant?
Yes,
Yes,
sir.
sir. Understood, sir.
Okay.
Okay. So we discuss what price we discuss. There are two price, market value, returns we discuss. Let's discuss what is risk now. Very important concept in finance is risk and return concept, because return and risk should go parallelly. Okay. Let's discuss now what is risk. First of all, let's meaning of risk we'll discuss. The general consensus is that it's the likelihood, or we can say value of you losing your money. Okay. Now what is risk? In general terms, it's a likelihood of losing money. That's nothing but your risk, right? So it means when you have generally when you do investment, there is a likelihood of making the money also, but there is also a likelihood of making losing the money. That is nothing but your risk, right? So it's nothing but what, again, this risk will be in percentage, right? So what percentage of money I will lose, that's nothing but your risk. Am I clear?
Yes.
Okay. So we discussed three concepts: price, return, and risk. Remember, friends, price, then we discuss return, and last one is risk. And these three concepts, incredibly, they share very powerful relationship. There is a very important relationship between this all this concept. There's a there is a relationship between price, return, and risk. Okay. Now let's understand this with two example. Okay. Example number one. Okay. Let's consider. Okay. This is MRF, and this is, okay. Let me take here. Um, Suzuki. I will take just randomly. I'm taking example, and here there is a TVS. Okay. Two companies. Okay. Just let's try to understand this one. First one I'm writing expected return. Okay. Second one I'm writing risk. Let's imagine the expected return of Suzuki is 10% and the expected return of TVS is also 10%. This is hypothetical example, not real. Risk of Suzuki is 15% and TVS risk is also 15%. Okay. Now, what is the third concept? Can anybody tell me? We told no, there is a relationship we can arrive with three
Price.
concepts. What is the third one?
Price.
Price. Perfect. Let's imagine the price of this company Suzuki is 100 rupees. Okay. Now the question is how much you will pay for TVS. Okay. Question is how much would you pay for TVS? That's a question. Okay. Just an hypothetical example, not real, for classroom understanding. Imagine expected return of Suzuki is 10%. Expected return, okay, just an expected return. We can say average return. TVS 10%, Suzuki 10%. Risk is also same of both the stock. Price of Suzuki is 100. How much you will pay for TVS? Any guesses?
100
You can put
rupees.
the answer in the chat box. You can put the
100
answer in
rupees.
chat box.
100,
Yeah, I
yeah,
think
100
Nagesan
rupees.
sir is telling something. Yeah, 100 rupees. Okay, one answer I
For
got.
TVS, yeah.
Yeah, or something less than 100.
Less than 100. Okay. Next one. Any other answer? How much you will pay for the other company? Yeah. Any answer in the chat box? Hello? Am I audible? Dilip sir?
Yes, you are audible.
I'm out. Okay.
Yes, yes, you are.
Yeah. What's the price we will pay for TVS? Generally, if I give this information to you,
It should be below 100.
it should be below 100.
Otherwise, accept Suzuki itself.
Accept Suzuki is a perfect. Right.
Otherwise,
Will I pay more than 100 rupees for TVS? Ideally, what should be the price? If stocks, return and risk both are same, then as an investor perspective, when I'm giving this to option to you, the ideally the price of both the stock also should be same, right? Am I
but
correct?
but practically it is not possible. Yes,
Practically it is not possible,
hypothetically, yes, we can.
but actually practically it is never possible. We'll discuss that concept will come now. Ideally, what should be the price then? It should be also equal to how much? 100 only. Why we are ready to pay 100 for this stock? Because the same asset having risk and return both are same. So obviously the question comes here, the stocks are identical, their prices also equal, right? The prices should be equal actually. That's the first concept over here. What if the second case, okay, what if the second one, if prices are not equal, let's take for example, this is 101, this is second one. What if the prices are not equal? Because practically it is not possible, right, to have same stock, same return, same risk, prices are same. It is unbelievable in because in today's market. But what if there's prices are not equal? So it means for Suzuki 100 rupees, for TVS there is 101 rupees, means both the prices are not equal here. Practically this can be the case, right? So when prices are not equal, there is an option, or we can say there is an arbitrage opportunity exit. Is it possible or not? What is arbitrage opportunity here? Now, identically, what we are discussing here, law of e- price says that when two stocks sharing the same information, the prices should be equal. That's called law of one price. But what is happening here? Let's imagine if the prices are not equal, then there is an opportunity for arbitrage. Is it clear?
Okay, we'll proceed. Okay, there is chances.
There is a chances of arbitrage. So it means, strictly speaking, when we say what is arbitrage, one can earn money with zero investment or risk free. There's a chances. Purely there's a chances. So we discuss this concept over here. So when the prices are not equal in two stock with the but they are sharing the same information, then there is a arbitrage. Okay. Shall we proceed with the next concept?
Yes.
Okay. Now let's discuss one more example. Example number three. Okay. Again, I will take here from this some information. Okay. Now this time I'm changing certain person. This is my third example, I believe. Okay. Now let's discuss the next concept over here. For example, if you say this is 10%, this is 10%, and this is I'm keeping as 15%, and price is this much. This is my third example. Return of Suzuki is 10%, return of TVS is 10%, risk of Suzuki is 15%, and TVS risk is 20%. Price of Suzuki is 10 because similarly these companies are identical in approach. Okay. What price you will pay for TVS? How much you pay for, will pay for TVS? Any idea? Should it be more than 100 rupees or less than?
It will be less than more than 100. Less than
It
100.
should it should be less than how much? 100. Now, why we are paying less than 100, that we'll discuss now. So, all of you agree that it should be less than 100? Other participant, you can tell me. Dilip sir?
Yeah, yeah.
And what are others? Divya ma'am? Okay. So, identically, the price of the stock should be how much? Less than 100. Now, tell me, why we are not ready to pay more than 100? In both the case, okay, here we did not found any of the risky asset. But here who is risky now between Suzuki and TVS?
TVS.
TVS is more risky than Suzuki. So we can say what is the riskier asset are worth less than safer assets. Is it making a sense? This definition, this meaning? Yes, sir.
Can
Yes, sir.
no,
So it means riskier assets are worth less than safer asset, right? So mindset of investor is what? Why I should pay more than what the stock is? For it's a risk is high. So for riskier asset, why I should pay more? That's the psychology will come from the investor perspective, right? So it means what? What we can derive here, okay? The asset which are risky will be worth less than the asset which are safer. Okay, this is third example. Let's go to the next one. One more example we'll discuss. Fourth one. Let's imagine here it is 10, here it is 15, here it is 8. What should be the price? How much you will pay for TVS now? Again, there are two same concept, but I changed the
More than
percentage.
100.
So you will pay TVS how much price? More than 100 or less than 100?
More than 100.
More than 100. So it means the price of TVS I will pay more than 100 rupees, right? So what we can arrive from this particular concept? What can be right conclusion? What is the conclusion from this? What is riskier? Which now tell me, was it a riskier asset or safer asset? TVS was riskier asset or safer assets?
Safer assets.
So
It
in the
was
last case, it is safer asset because risk level is low.
risk level is low. So in this example, we can say what is our conclusion here? Safer assets are worth. It should be less or more.
More
More than which asset?
riskier.
Riskier
Riskier
assets.
asset.
That is a conclusion. So what is an important relationship? What is the relationship is arriving? Let's discuss. The value of, so what we have learned from till now, what is the discussion of point from this is the value of an asset increases as the, when the value of asset will increase, when the risk will increase or risk will decrease.
Risk decreases.
Risk decreases, so it means the asset value will increase as the risk decreases, and the same way the value of an asset decreases as the risk is increases. Is it making some sense, this kind of terms? Am I
Yes.
making some sense here? Okay, now
Yes,
this
sir.
is between value of asset and risk, right? Now just tell me one more important relationship I can make it here between the assets. Okay, I'll just go to here. Let's write here as the risk. One more important relationship, as risk increases. Okay, tell me the expected return we write as ER is, tell me, when the risk increases, expected return will increase or decrease?
Should increase.
It should increase. So we can say as the risk is more, the expected return also should be more. So we say expected return increases. And let me here only write and vice versa. I can say it's a vice versa. Vice versa means as the risk decreases, the expected return also decreases. This is one important relationship we arrived. This was the first one, this was the second one. So now let's make a consolidated table. Okay, here I will write as risk, and here is my E bracket R, and here is my price. Okay, all of you please concentrate here. Let's, very important powerful relationships in finance. The base is this one. To go for further returns and risk, to understand the investment concept is to know the base of this relationship. Let's imagine one situation. As risk increases, tell me what happened to expected return? ER means expected return. What happens?
Expected returns should increase.
Expected return increases. Now, let's define this is between risk and return. Now, let's define the relationship between risk and price. As the risk increases, price should be when
Decreases.
price decreases. So, it means the asset which is more risky, you will not pay more. So, the price decreases, right? Reverse of this. As the risk decreases, tell me, when your risk is decreases, expected return
Decrease.
decreases. So the asset whose price is, we can say the risk is less, then the asset price will
Increase.
increases. This is what you need to understand in finance, the relationship. Am I clear with this concept?
Yes, sir.
Got it, everyone? Any doubts till now?
No, sir. Going fine.
Fine.
Here you're considering risk as the measurement tool. First
Yeah.
part.
Yes, sir.
Okay, okay, okay.
So it means
It
we
may
our
change if we consider the expected return as the measurement,
measurement.
I think.
So
Is it
if
so?
I take as the base as return, expected return,
Mm-hmm.
then there are some chances is that the risk may not be the equal or it may not be the same case.
Okay.
But here my base is the
Base
risk,
is risk. Okay.
which is deciding the expected return as well as the price.
Okay. Okay. Okay.
Shall we proceed with the further concept?
Yes.
Yeah. So till now, our discussion, what we started with the concept of investment, then we discuss what is dependent, independent, and then investment we discuss is the function of your savings, and investment is a function of income. Then it can be on return on investment, interest, price, two types of price and market value. Return we discuss the amount of money which you make from your investment. Okay, and risk is nothing but the likelihood or losing of your money. Then we discuss the relationship between all these variables, right? So now let's discuss the concept of further returns and risk through here. Okay. So now, how do we calculate these returns, right? How to returns? First, our discussion will be next topic. Discussion will be on completely on returns. Okay, is it clear? Okay. Now, returns, when we say, we discuss already the meaning of returns. These returns can be calculated in different ways. Okay, let's, for example, when we say the stocks returns, we can calculate in two ways. Okay, with without dividend, what is the return on the stock? And second one is with dividend, what is the return on the stock? Okay, we are talking about the stock returns here. Okay, let's discuss the first concept of stock without dividend. So how to write this formula? Okay, first let's take, imagine there is a stock and we want to calculate the returns of that stock. Okay, how do we calculate? There are two ways: without dividend and with dividend concept for returns calculation. When we consider without dividend, how to calculate this one? So we say the return of a stock is nothing but, let's some variables I'll write, pt plus 1, okay, minus pt divided by pt. Okay, what is the notation of this particular concept here? Okay, what is written without dividend? I'm not considering dividend yet. Assume that the stock is not paid any kind of dividends. So what is pt plus 1 here?
So it is the current profit or current return that we are getting.
Yeah, so pt plus 1 is nothing but today's value in simple language. So this is your which value? Today's value. And if I take pt, there is a second notation is available which is called pt. If pt plus 1 it's today's value, then what should be pt then?
Previous day's value.
Previous day's value. So we can say it can be your beginning value, previous day's value, right? Now let's discuss this formula further. Okay, this returns can also be calculated like this. Return is equal to pt plus 1, sorry, pt plus 1 minus pt divided by, this was the original formula of pt. Now let us substitute this formula. pt plus 1, right, divided by pt minus pt divided by pt. Okay, now further I can write this formula pt plus 1, okay, that's today's value, divided by pt minus pt divided by pt is nothing but how much? Anything divided by itself is always equal to how much?
1.
1. So it will becomes, what is written now? Written is equal to pt plus 1, today's value, divided by pt minus this one. Is it clear? I'll write in my notation. Is this formula is trying to make some sense? What is pt plus 1? How do you derive with this formula? Today's value is nothing but pt plus 1 divided by pt minus 1. So let me write here. Okay. So what is written is equal to pt plus 1 minus, is it visible my screen?
Yes, it is.
Yes.
Divided by pt. Okay, so I'm writing this formula like this. Written is equal to, okay, pt plus 1 means today's value minus yesterday's value divided by yesterday's value. Pt plus 1, okay, minus pt means yesterday's value, divided by pt. Again this can be written like this: pt plus 1 divided by pt minus pt divided by how much? Pt. So r is equal to, so anything here, I was talking about that equation. Anything divided by itself is how much? 1 always. So we say it's today's value, that is called pt plus 1 divided by pt minus 1. Is it clear?
Yes.
What about others? Is it able to make some sense?
Yes, sir. So we are basically trying to determine the change here. What
Change
change?
here. Yeah,
Yes.
yeah. It's nothing but what the exactly you're determining the change over here from the today's value to previous value, right? But this will be again considered in percentage terms.
Yes,
Then we
sir.
have to multiply into 100.
Then further what you should do, you should multiply with 100 to get into the percentage value over here, right? So, but usually when what's the logic behind this one? Because we can say always your profit is nothing but selling price minus what? Purchase price, right? So, what is purchase price? The cost of that particular asset. We can say your profit is equal to this selling price can be written like this PT plus 1, correct? So because it's a today's value, what I'm going to sell it, right? This selling price I'm replaced with PT plus 1 minus this purchase price. PP means purchase price. I can write it as what? PT. Is it making sense?
Yes.
So profit is nothing but selling price is PT plus 1 minus your PT. Now what is this PT exactly in finance? It is nothing but the date of purchase. The day when you purchase the stock is called your PT, or we can say the month, okay, the month of purchase. Anything can be PT. Is it making some sense? Okay. Is the formula is clear? What is we are trying to calculate from here? What is basically this profit? This profit it's showing. Profit can be usually it shows either in the form of rupees, or it can be in the form of dollars, or it can be in the form of any kind of pound. You earn, you're earning from your investment. From your investment. Okay. So it means let's example we'll take here. Suppose for example, you bought, okay, FB shares. FB means Facebook shares at dollars 160 rupees. Okay. And you're sell it. Let's say you're selling it for, I'm putting some numbers here. Dollar 192.73 rupees. Now question is what is profit, okay, and what is return? Can we calculate from this? Is I think the little bit handwriting is not clear, but is it making some sense what we are writing here?
Yes.
Okay, so first what we'll calculate? We'll calculate something called as what? Profit. What is the formula for profit here?
So selling price minus cost price.
Selling price minus cost price. Let's say you bought FB shares, Facebook shares at 160 rupees, and you're selling it for 192.73 rupees. So this selling price, I will take it as PT plus 1 minus this you bought, right? Bought means purchase price. At what price you bought, that is we'll consider as what? PT, right? So let's take what is my profit. First we'll calculate profit here. So what is the profit we'll calculate? We'll take selling price 192.73 minus 160 rupees. So how much dollars you will make? So what is the difference between these two value? Minus 160, I think it's 32.73. Is it correct?
Yes.
32.7. Now this is profit, right? The profit what you earn, okay, it's in dollar. Just now we discussed what is the meaning of profit. It can be any value either in the form of rupees, or it can be in the form of dollars, or it can be in the form of pound. You're earning from your investment. This is the concept of profit. Now we are, they have asked us to calculate even return also. Now if profit is in form of value, then return should be in the form of what? Percentage. So can we calculate percentage for this? So what is the formula ultimately? R of what? FB, that's called return of Facebook, is nothing but, what is the formula? PT plus 1, today's value, divided by yesterday's value pt minus 1, right? So r of fb is equal to, what is the today's value? Pt plus 1
One
was how much?
192 point
192.73
73.
divided by what was the purchase price? Dollar
16.
160 rupees. Okay, minus 1. Let us write down RFB is equal to 192.73 divided by 160. How much?
0.20. So
Point
one
two
one. The total final answer is 0.2045.
0.2045. After dividing, then minus 1 is, this
Of
is the,
one. Yes.
this is the value we'll get, right? Am I correct,
Yes.
Dilip sir?
Yes. Yes. Yes.
Now this, what we want in percentage. So what we'll do, we'll multiply this with 100. So R of FB is equal to 20.45, or we'll take approximately how much return? 20 percentage. Is it correct, everyone? Are you getting the how we are deriving the returns?
Yes.
Now this also can be written like this, right? So we can write R is equal to PT plus 1 minus PT divided by PT. This also way we can write this. So we can say 192.73 minus 160 divided by 160 rupees, right? So R is equal to dollar 32 point, the difference between 192 is 32.73 divided by dollar 160. I think we should get the same answer, this 0.20. Am I clear?
Yes, sir.
So in both the ways, this is basically what we are talking about. We are talking about how do we calculate the returns in the form of what? Percentage. Okay. Now this is one concept. Now tell me, this formula was with dividend or without dividend?
Without dividend.
Without dividend.
It was without dividend. What if the stock is paying dividend? So dividend is a return on shares, right? So in that case, we'll discuss the next concept. Returns, I'll write here. Returns, how do we calculate if with dividend? What if there is a dividend is given? So let's see here. Again, I will write the formula. R is equal to, R means return, PT plus 1. PT plus 1 means today's value plus dividend, because again we are going to add the dividend with selling price. Okay. This is with dividend minus PT divided by PT. Is it making some sense, this formula? Yes.
Yes.
Now,
Yes.
in terms of, this is what we got. Let's say if I want to say, let's say profit, because we started, remember, profit is the selling price minus purchase price, right? So if I write like this formula here, selling price plus some dividend minus purchase price. This also can be rewritten formula. Now here this is returns. This formula is for your returns, and this formula will be for your profit. So it means selling price can be written like this: today's value PT plus 1 plus your dividend minus PT. So this is the formula for your profit. Is it clear?
Yes.
Okay. So we discussed two formulas, with dividend and without dividend concept over here. Okay. So let's discuss now this concept. Okay. How do we do calculation of the returns? Okay. Um, did you people open? Did you save that file which I sent, one data set Facebook shares All of you people have it downloaded in your system.
Yes.
Can we go with the concept now? What basically we are going to discuss? Just can we go to the that data set what we have shared? I'll just open that data set. I'll just go to this one. Please open that Facebook data set to everyone. Be ready everyone with that data set what I shared. Is the screen is visible?
Yes, sir.
Yes, it is.
Okay, let's do it. I hope you have opened the data set of. Now we'll do some calculation over here in Excel. Please open that Facebook share price data set. Okay, we'll give here one heading. We'll add one more variable called as returns. Okay, let me write yes FB return Facebook returns. Please write on this one Facebook returns. Okay, so which formula will apply? We'll apply this formula. Returns is nothing but today's value divided by yesterday's value minus 1. Okay, we'll apply this formula and calculate what is the daily returns. First let us understand this data set. This is daily prices of Facebook. It starts with 18 Feb May 2012 to 29/12/2017. Okay, so let's go here and calculate. Now today's value divided by yesterday's value. Now today's value divided by yesterday's value. Before 18 May, there is no value. So the first day return will be how much? It will be 0. Why it will be 0? Because previous day there is no value over here. So I'll take this as my base for calculating the next day returns. Okay. So shall we calculate all of us? Shall we?
Yes.
So
Yes.
please type is equal to, okay, take the value today's value, this is your today's 25th 21st May, today's value divided by yesterday's value minus 1. Today's value divided by yesterday's value minus 1. So all of you got the answer this one? Am I clear?
Yes, sir. Got it.
You got this written, right? Now what we should do, you can just, this is called as autofill. You just double click on this one, you will get the returns for all the days. Just double click on the edge of that button and you will get all the days returns. Is it, did you got the answer?
Yes, sir.
Okay. So now what we got here answer, I hope everyone have got the same answer. That is your returns of daily. So you can just one example we'll take. 18th May Facebook share price was 38.23 and 21st May it is 34, means there is a fall, means there is a negative returns for the day. Okay. Now question comes here. Whenever we want to take the any stock historical data, so what usually we do, there is a way of downloading. How did you got this data set? There are many ways of downloading this data set. Okay, one way of is what, through Yahoo Finance. I shared already to you the data, but how do you get that data? I'll uh, show you two paths for downloading data. One is you can get through just in Google, you can just type. What happened to this? Is my screen is visible?
Yes, it is.
Yahoo Finance. Please type Yahoo Finance and then you have something called the first link. Go to this one, Yahoo Finance. Okay, and the moment you click on this one, you have something called as search for news, symbols, or companies. There are two ways to search. If you know the ticker of the company, okay, you can search, or you can type the name of the company. There's a two ways. Let's check. If I want to download Facebook company share price, then I should know what is the exact name of Facebook is Meta, right? So I can take this particular company share price through what? Meta, and you can just take it whatever the prices you get. That's the two ways of downloading this particular company's share price. So this is how you get it. Okay. Then once you type your Meta, you will get this is a price. Okay, it's in Nasdaq real time. On the left side, can you see there is something called as historical data? All of you, can you see? On, you have to click on historical data, and from this historical data you get the past data of this company. You can see here, this is in dollars. They have written currency in USD. So from what range to what range you are looking, you can put your date. Okay, so you can select 5 years, 10, and you can select according to your date wish, and historical price and daily, and you can click on download. This is one way of getting the stock price of any companies, whichever listed companies. You can download the data from Yahoo Finance. Okay, you understood the first approach?
Yes, sir.
Okay, there is another way like this. Imagine if I want to type every time the data, if I want to get it from online, means I have to visit this website and download. There is another way of downloading this data. Okay, if you do with me, I think it will be helpful for you. You can go to this your Gmail account. There is something called as sheets. Can you see here on the right side? There is a sheets are there. You click on this sheets, we called as Google Sheets. Okay, and in that there is something called as blank spreadsheet. You please select. Okay, in Google Sheet you can select blank sheet. Okay, did you got it? Okay, so how to download the another way of data from this particular website, I'll just show you over here. Okay, I hope you're till here this particular page. If you're ready, please let me know, any one of you. You can
Yes,
open.
sir.
Okay, so now let's do with this particular concept over here, and we'll download the share prices from the web, this particular Google Sheet over here. Okay, what you should do in this particular website, okay, just come to any of the cells, whichever the cells you are willing to type. You can just come to this particular cell. Okay, let's say for example, if I want the data from here, so I can come to this A2 cell. Okay, just type here Google Finance. Okay, double click on that Google Finance, double click. Okay, now first thing, what it asking in the bracket, what is this? Ticker. What is the ticker meaning here? Ticker means what? It's the name of the company it's asking, right? So for example, I'll take it from here. What is the ticker of this company is Meta, right? So earlier it was FB. I could have typed FB. Now I'll type as Meta. Let's see whether it will come or not. Okay. So when you're typing any company name, no, you should always type in double inverted. Okay. Type here META, Meta. Type is equal to Google Finance. Open the bracket. Type here Meta, double inverted, close. Now, what it asking? Attribute. Attribute means when you download any data set, there will be something called as open price, low price, high price. close price, adjusted close. Yes or no? So what I will do now, I'll take the close price, okay, which is nothing but your adjusted close to be here. Okay. Type close in double inverted, comma. Now what it asking here? Start date. Now from which date you want that particular stock to be? Okay. Let's say for example, I'm putting like this 01 slash again 01 okay 2012. I'm taking the data from there. Then close it in double inverted. Press comma. What is asking next one? Interval, or we, sorry, not interval, it's the end date. What is end date here? The closing date, till where you want the data. So I'll take it here 12, okay, 31st month and then date, okay, divided by 2017. This is the range of my closing. Double inverted, close it again, press comma. What is the next thing is asking here? Interval means whether you want monthly, weekly or daily. So in our data set, I think we have taken daily, right? So again, type double inverted, type here daily, double inverted, close. Okay, I think we have finished all the parameters. Then close it. Okay, and just let's see, did you got it? See, I
Sir,
got the closing
can you
price.
repeat it from the beginning, sir? Because we missed on understanding the ticker part.
Okay, fine, I'll just do it once again. Please type is equal to Google Finance. Double click on that. All of you there? Shall we? Now type here double inverted meta. One second. Did you type meta? Double inverted, close it, comma. Then type again double inverted, close. It is asking you what is the basically attributes. So when it comes to attribute, you just type close. Okay. Press double inverted. Then what is the next thing it asking? Start date. So what is the start date you will apply here? Let's check. I'm any dates whichever you want, you can take it from there. 01/01 divided by 2012. Are you doing with me, along with me?
Yes, sir. Try.
Okay. So then what I will do again, comma, write the close date 31st, sorry, 12, 31st again divided by 2017, double inverted, close, comma, daily, double inverted. Okay, that's called your final interval of the data. Close it. Is these parameters are clear? Okay, so if you don't know the company sticker, I will help you how to get it, that one. Okay, there is a alternate approach is there. Yeah, I'll help you in that. But are you did you done till here? I'll tell you what is the ticker for. How do you get the ticker?
Yes, sir, we are doing, but we are not getting the way you are able to do.
Okay, are you doing the proper function applying, ma'am? Whatever I have applied the same way. Did you apply it the same way?
Yes, sir, I applied.
Make
You
sure.
can you can paste in the chat box, sir, so that
Okay, I'll
she,
shall I copy the syntax only?
yes, that would be better, I feel.
Okay, I'll just take it. You please.
Because of date, if there's change, the
Ah,
first is month, second is day, and third one is year.
yeah. I have put in the chat box. Did you got, ma'am? Yeah. So now what I will do now? The question was, what if I don't know the ticker of that company, right? So you can take help of multiple website over here. Now you just please tell me one company name where you want to download the data. Okay. We'll take it company of Wipro. Shall we? Can we? Can you all of you please do it? Those who I got, can you work on Wipro and check whether you will get the daily same date? You can put the word there. Okay. Can you see this Wipro Limited? I'll take this one, equity NSI. Okay. I'll click on that Wipro. Now did you got this one? What is this in bracket? Did you got this one?
Ticker.
This is your ticker. Madam, I think one ma'am was a Natika ma'am, right?
Yes, sir, got it. So
Yeah.
Wipro.ns is the ticker, right?
Yeah, this bracket is the ticker.
Means we have to go to the Google only to search the ticker, right? We
Yeah,
will not be able to get in the Google sheet directly. Huh?
yeah, because it is registered in the name of Wipro Limited only, but how it is traded in the market is in the name of Wipro.ns here.
So
That's
my
it.
question is like I have to go in Google or in Yahoo Finance to search the ticker, right?
Yeah, yeah, correct.
Yeah.
So will shall we try with Wipro now, all of us?
Yes, sir.
Okay, so now what I'll do now, I'll add one new sheet plus. Okay, you also please do along with me, everyone, because in classroom you should able to tell to the students how it is beautiful this spreadsheet Google Finance. Okay, just type Google. We are taking the help of Google Finance. Open the bracket. Okay, now tell me what we should do here. What is the first thing we should type here? Anybody?
Google Finance.
Google Finance. Open the bracket. First, we should always start with in bracket ticker. What is the ticker of Wipro?
Wipro.ns.
Huh. Let's see. Two ways we'll do it. Dot .ns or we can say Wipro also. You can type, no problem. Okay. Let's see whether either way it will work or not. I'll take it with the Wipro only. Okay. Comma. Whenever you're typing, no, put it in double inverted. Okay. Let's see. Okay. Then after that, we want closing price, comma, double inverted, close. Again you should put double inverted only, comma, put one date, any of the date whichever you want. Okay, let's see with the same date only. 01, again 01 2012. Okay, that is your starting date, from where to where you want the data. Okay, again double inverted, close, comma. Now next one, it will ask you what is the end date. Okay, so what is the end date? I'll take it here, again double inverted. Okay, put 12 month, then date 2000, let's say 22. I'll take it till 2022. Any date you can put whichever you want. Press comma, close it, and then press comma. Again press double inverted. Now it will ask you interval. Interval means the frequency of data. I'll put daily, 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 double inverted, then close the bracket. Is the syntax is clear now? Shall we check? Is it coming? Hello? All of you got this? Or do you want me to copy paste that syntax?
No, Wipro.ns is not working.
Wipro.ns is not working. So we can just type the name of the company, that's ticker. Is it clear?
Only Wipro is working, but not Wipro.ns.
Wipro.ns is not working.
No,
I That's why I just typed directly Wipro, because either way you can take it, either .ns or Wipro, but Wipro is the best way to you can get it over here.
correct.
So what is the difference between Wipro and Wipro.ns if we take? Same
Oh,
answer it will get.
same answer you should get. .ns means it is NSCs.
Okay.
Here you can see, ma'am, NSC. Can you see? It is registered in NSC, so it's taking the price from that NSC like this.
So if I take Wipro also, then also I will get the same answer.
Yes, yes, you should get the same answer only actually. Is it? Are you working with me along with me so that your work will be, your time will be saved so much in Google Sheet when you do this kind. Now, this is your data, right? Just copy and paste it in Excel, or here only you can do many analysis and all, whichever data we feel like working over there. Okay. So shall we go it now? Our next concept over there. You got this returns, right? I'll just share this syntax with you all.
Yeah, when I did Wipro.ns, it's giving me error. But when
Ha,
I did only Wipro, it is happening.
ha. So please type only Wipro, name of the company. That's more than enough now. So I'll share this one in chat box. Am I making sense now? Hello? Shall we go to the next concept?
Yes,
Yeah, we'll proceed now because we have to discuss many things over here. Now we got to know what is our returns, which is nothing but your daily returns, how to calculate, right? Okay. You be please be don't close your Excel file. What we calculate the returns. Okay. Let me just go to the next concept now. Next concept. Okay. Next concept is returns versus expected return. Okay. This return is your actual returns. We call as AR. AR is your actual return. And this is your expected return only. We call as ER. Now you tell me the difference between actual return and your expected. Now when we are investing in any stocks, okay, when I'm investing any stocks, we take some certain decisions, right? We want to take the decision of investment in any stock. We take decision based on, decision means it's a future, take future decisions. We take investment future decision based on, you have to answer me, any one of you can unmute and tell me. We will take decision, should I take decision on actual return or expected return? Usually what we do exactly in market.
Expected returns.
Yeah, perfectly correct. Whenever we take any decision, we don't take decision based on actual return. We take decision based on which return? Expected return, right? So this expected return is nothing but historical performance of any stock. This is a performance, historical performance of any stock. So we base our decision, we can say investment decision, based on the performance of the stock. That is called expected return. Okay. Now the question is, this expected return, okay, we called as ER, expected return bracket I'll write here ER is calculated in many ways. Okay, what are the methods, or when I say ways means methods of calculating expected returns? The very first method which we use to calculate expected return is historic average return. Historic average return, that's the first method to calculate expected return. Okay, the second method to calculate this expected return is state contingent. Okay, state contingent weight probabilities. Okay, probabilities, this is the second method to calculate expected return. And third method, we can calculate expected return through asset pricing model. Bracket, we'll write it as APM model. Okay, so there are how many methods are there to calculate expected return? Three methods. Okay, historic average return method, state contingent weight probability method, and the third one is asset pricing model method. Okay, each one I will discuss in detail. Very interesting, these three methods are there we use in finance. The very first method which we are using over here, first of all, is it clear? There are how many methods? Shall I proceed with the next one?
Yes, sir.
Okay. Now, let's talk about the first one. Okay. What is the first method name? What is the first method name? Can anybody?
Historic average return.
Historic average return. That's the first method to calculate the returns of expected return of a stock. So, what is average return? Average return. This return is method is also called mean method. Okay, this is also nothing but your mean method of calculating the returns. Okay, now let's see. Now here onwards, I'll be writing the formula for entire expected return as E. Okay, let's make all of you please see here the formula for this method. E R expected return of R J is nothing but 1 by n summation of n, this is n, t is equal to 1 of R J. Okay, this is a formula for your average return. Okay, I'll discuss what is this RJ and what is ER and all. Okay, let's discuss now. Here only I'll write down. First thing is ER stands for what? Expected returns. ER means expected return. Okay. Next, what is the next one we want to know? This is J. Okay, this is J. RJ is nothing but realized return on stock. We called as, this is your stock return. We called as realized return. Okay, it's a realized return of stock J. J means it's the name of the stock. Okay, next one is your N. N means what? Number of observations. N is your number of observations. Observation of what? Observation for stock J. Okay, am I clear with this?
Yes, sir.
Now you see, can we rewrite this formula? We can write like this: E of Rj, expected return on Rj is equal to 1 by n, okay, bracket open, Return of stock J at the time of 1 plus RJ2 plus so on, right? RJN bracket close. So it means what is this RJ1? Those are called as what? Realized return of stock. Okay. Now we can write this formula like this further. Okay. Expected return of a stock of RJ is equal to, now we will multiply all this realized return with how much? What is this? It is 1 divided by n bracket open. RJ1 plus RJ means all the sum of all the returns into 1 divided by n. So can I write this formula like this also? RJ1 plus return of stock at this time 2 plus so on, right? RJN divided by n. This is the formula for expected return. We called as average return. Am I making sense with this formula?
Yes.
Hello, others participant,
Yes, sir.
right? So this is formula for which to calculate which return? Average return. Okay. Now, please go back to your Excel sheet. Okay, I'll keep this one. Please, all of you open your Excel sheet. Okay. I hope you can see my screen. I have Facebook returns. Okay. The first one is, we'll write here E bracket R expected return of which company? FB is how much? Now, which method I'm going to follow? Average method. So all of you please go to your data set where you have calculated already. So expected return of Facebook. Okay. Expected return means the average return of Facebook. Right. So can we calculate? Then what we should write formula is equal to average. Please write this is equal to average. Okay. Let's take the average of this particular. Okay. Select this one. Close down. Entire column you should select. Close the bracket. Did you got this value? All of you?
The FB returns is not in percentage. Am I right?
Yeah, it is not in percentage. First, we have to convert this into percentage.
Okay.
0.001348,508. Is this answer everyone got? I'll double click the formula. Please look at the formula, everyone. C2 to C last column. Only returns you have to select. Okay. Close the bracket and enter.
Sir, we will select from cell C2
Two. Yeah, yeah.
because, but
C2.
sir, C2 we have not applied the formula. The value we couldn't calculate because of the previous day's price.
Right,
So
right.
does it make sense taking from C2 or we have to take from C3?
Okay. So now, what is the logic here? We don't have any returns, so previous value is not there. So that's why this is my zero returns only actually.
Sir, actually the value we have not taken that date, na?
Hmm.
There is a date. We have not selected that date, the
Correct.
previous date. So the value as we have assumed it as 0. If I take the previous 17th May, then the returns would come. So does it
Correct.
make logic? Do we take from C2 or C3?
You take it from C2 only, ma'am, because when I'm considering that one as from the day one, I'm calculating the returns.
No, but so we didn't calculate from day one returns. We calculated from day two. Day one
Yes,
return zero we have written because we didn't had the previous price. But we
correct.
didn't calculate return for it.
Okay, so let's see what makes a difference over here. The n value will change here then. The
Yes,
number
sir.
of
That is why.
observation.
If the n value changes, your return value also will change.
Return
Na?
value also changes, correct. So what I'm considering from that particular day as my return itself. If I had could have been value means I could have taken from zero it's that day only. But what we should consider, it doesn't make that much of difference over here when we calculate over here. But what will change only the n value will change here. Are you getting the ma'am? Hello.
Yeah, sir. Here, as per her point,
Hmm.
uh, it does not make much differences when it is the use data, that to daily data. If we have only 4 or 5 variables observations,
Hmm.
then if we take it the zero value also, then it is a huge differences. But as of
There's
now,
there's a single variable. I think that's
yeah,
not makes much difference here.
here if I take it from C3 or C2, that is not much differences with the answer. But if we take only the few observation, let us assume that we have yearly prices of only 4 years or 5 years.
Hmm.
Then if we take it from zero, then it is a huge
Huge
differences.
difference here.
Yeah,
So my point is like technically which we should take, whether from
Nikita
the
ma'am, you're
first.
right, ma'am, you're right.
uh
Okay, take it from C3 only or
Yes, sir.
C2. In this case, it does not make any differences because the data what sir has given is huge. The
So
number of
my point is like whether it is a small data or whether it is a large data. I will not, as an analyst, I will not see the data is huge or data is small. I have to go with a logic, like whether I should take from the second or whether I should take from the day one. So
Okay,
it
ma'am.
has to be a common logic, whether it is a small
correct,
or whether it is a huge.
Okay,
correct.
okay, ma'am. Yeah, your logic is here. It is in this formula, ma'am. What we decided here, return of expected return is from the day one, right? First day, second day, as on till RJN. Are you getting, ma'am? So first day, my there is no return. Assume that I purchase on that particular day, so there is no return. So I'll take it from the day one.
But sir, day one you will never get returns. If I
Obviously,
invested today, yes, sir. So suppose if you are investing, for example, like if I invest for 5 years, right,
hmm,
and if I invest at the end of the first year, so I will get actually interest of 4 years only. I will not get interest of 5 years. So in we write N5, but then actually the calculation of interest is 4 years only in that case. Same I am telling here, the N should be of that count only from the day we got the returns, because you're calculating returns.
hmm, correct. So
So my
we'll
point was like we should take from the C3, not C2. C2 also we can calculate. We have the data in place. We have not chosen that date. So we couldn't calculate the returns of day one.
perfect. So let's take from C3 and we'll calculate the average return. Let's see what difference it makes. Shall we do it, ma'am?
Yes, sir.
Yeah. So let's say for example my C3 is minus from this value to control shift down. I'll take it entire this observation. You got this one, ma'am?
Yes, sir.
Okay, now what I will do, I'll take this one. Now this I will, what I will do, I'll convert this into percentage. These two value will convert this into percentage. We'll take how much point decimal? 2, 3, fine. Did you convert it everyone percentage?
Yes, sir.
So what is 0.135?
It's a daily average return.
Daily average return. It means what? If you invest money in FB means Facebook, every day on an average you will earn, because this is in percentage, right? 0.13 percentage of return. Is it clear?
Yes, sir.
Natika ma'am, are you clear?
Yes, sir.
Okay. So now we got the concept of first method called as which one? Average method. We got it, that is 0.135 percentage. Okay. The next one is, now this is daily, right? So we have daily return. So what is my daily return? That is, okay, I'll take it this value, this one. Now can we convert this into annualized return?
Yes, sir.
Okay, now let's see annualized return. Before that, let me explain you this concept of annualized return. Okay, so I will go to my slide. Okay, there is a logic behind this, everything. We'll do it in this one. uh, I just open my slide. So the previous was what method we followed? Average return, right? Now next is annualized. I'll write it as annualize. Which return we are talking about? ER. ER means what? Expected return. Is it? Okay. Now please understand here. Annualized returns are there are two ways to calculate annualized returns. Okay. The first method what we follow, okay, that is called CRUDE, crude method. Okay. And the second method under this annualized return is called sophisticated method. There are two methods to calculate annualized returns. Okay. What is this crude method? Okay. In basically in crude method, what we do, we multiply, okay, observation, that is nothing but daily returns, we multiply with daily, or we can say number of trading days. Okay, what we do, we multiply which return? Daily returns. What we'll do, we multiply with number of observation. Okay, it's actually number of observations, or we can say number of trading days. Am I clear? First method, crude method means what?
Yes, sir.
Okay, so approximately what is the number of trading days?
252.
252. Okay, some takes 252, some takes 250 days, right? That will be your number of what? Trading days. So daily returns multiply with number of trading days or number of trade observations over there, the data. This is your crude method of calculating annualized return. Okay. What is the another method we called as sophisticated method, which considers the time value of money concept over here. So what we do exactly in this concept of sophisticated method over here, we calculate returns. Okay, we are talking annualized return by considering 1 plus r to the power of n minus as the value of money, time value of money concept we are discussing here, 1 plus r to the power of as as the days changes the value of money reduces, so we say minus 1. So means value of money decreases over a period of time. That will give you the another method we called as sophisticated method to calculate which return? Annualized return. Now this n can be your trading days. Okay, it can be your trading days or it can be your number of observations. Am I clear with two methods? Shall you do it?
Yes, sir.
Yes, sir. Yes, sir.
Okay. So now, can you please go back to your Excel sheet? We'll apply both the method, okay? And we'll calculate. So I'll go to my Excel sheet. Annualize return, okay? First one, what is the first method name? Can anybody tell me? You can unmute and tell me. What is the first method to calculate annualized return?
It's a crude method it is.
Yeah, it's a
Average
crude.
return multiplied by 252.
Yeah, crude method is nothing but we multiply with daily return with number of observations. So let's say, let us write down annualized return, okay, is equal to what is my daily return? 0.135. I'll take this one, multiply, put multiply. So I assume that there is a 250 days of trading. You can take 252 also, no problem there. So we'll take it how much? 250 days of trading. So we got some answer over here. Okay. Now this one again it is in decimal, but what we need to do, you can convert this into always percentage. So we keep it to decimals. So what is the annualized return as per crude method? How much you got? 33.74. All of you getting the same answer?
Yes, sir.
Good. Now what I will do, what is the another method? Again I will write analyzed return according to sophisticated method. Okay. So here what we will do calculation, we will take is equal to, okay, open the bracket, 1 plus, what is my 1 plus r? What is r here?
Daily return.
Daily returns. So what is my daily return? 0.135. I'll take this one, close the bracket, to the power of n. So n is how many we took? How many trading days? 250 minus 1. So we got 0.44400. This I'll convert again into percentage. So how much we got? Is it clear?
Yes, sir. But I have a query, sir, that the difference between the annualized crude method and sophisticated, the difference is very high.
Yeah, yeah,
So,
yeah, yeah. We'll discuss
yeah,
what's
okay,
this.
okay, okay.
Everyone got this answer?
Yes.
Okay, now,
Sir, can you just repeat for crude method?
okay, I'll just, this is a formula, ma'am, is equal to daily return 0.135 into 250. I assume that there is a 250 days of tradings.
Yes, sir, got it. Thank you.
Okay. Now, annualized return, did you got, ma'am?
Yes, sir.
Okay. Now, question is, are this actual return or expected returns?
So these are actual returns because
Okay.
these are based
Expected
on the perform. No, these are based on the performances. It's already being performed.
Okay. Any other answer?
It is expected return.
This is expected return.
So the values which are of past is actual. When you
Actuals.
predict for the future, it is your expected. These are the past data which we have taken. So this is your actual.
This is your actual returns. Okay. So based on this, what we are expecting in the future, the Facebook return should perform the same. So we are expecting the same return in future also.
Yes, so based on the past performance, we are expecting that it should give us the same,
Same.
provided like the market performs the same.
Correct. So it means we are expecting the same return to be performed in the future. So it means this becomes my which return? Actual or expected then?
Expected.
Then this becomes my expected returns, right? So I expect the same return to be continue in the future also, right? Am I correct? Are you getting me logic here?
Yes, sir.
Okay. Now, what this difference arises here? Now, what we will do, we will compare usually what we should do in reality. This returns we should compare if it is you're taken annualized, no? Okay. Then we should compare with, uh, hello? Okay. Now, what we will do exactly, we should compare these returns with your actually how much we have got, right? So, what I will do now, just for your understanding, can you see my this website called markets.ft.com? Okay, this is a website which is FT means Financial Times. What you can do in markets, okay, here if you go to in markets, here you have something called as market data. So in this market data, you can click on equities, or you can right side there is an option called as search equities. Okay, that is also options are available here. You just click on here, just will type meta here. Options. You see, okay, I'll take meta platform. Okay. Now what if you want to compare this returns, no, you can compare like this. Can you see there is a one option here, something called as 1 year change? Can you see here?
Yes.
Yes, sir.
Huh. What you can do, this returns, what we got from annualized return, you compare with your, let's say if you're taking 1 year change, 1 year change return here it is somewhere 89.3. But what is our returns, what we got is somewhere, because the data is difference here, because these returns and their performance is different. But you can compare your expected return with your this return. So in that case, this will become your expected return. Okay, but actually how much the return is, if I take this as my base, so what is my actual year return, how much it is? 1 year change. If you're taking analyze the same volume of data, if you're taking same 1 year of data with performance, when you're comparing your expected with actual, so actual you will get from this website like this, you can see the 1 year change returns here. Are you getting the concept here? Is it clear?
Yes, so that means the change here they are mentioning it 90% and we have calculated it is 40. So my
Yeah.
understanding is 90 minus 40 will be the actual. It is something like
Yes,
that.
yes. So this becomes, if you want to, because you need to have comparison, no? What is the comparison we are doing here? We are doing the comparison between expected return with actual return, right? So I got my expected return. Okay. Now what I want to compare with what is the actual return. So 1 year on an approximately, what is the returns it has given? You can compare with this. So it means now if I want to say, for example, when this data set was downloaded, so what we can say, so your returns, whatever you're getting, no? So as per crude method, your returns, how much you got? As per crude method, how much we got return? It is 33 point annualized return. Can you tell me how much? Anyone?
33.74.
74. This is my crude method return. And what is my sophisticated method returns? 40 point somewhere, I guess 40 we got, right? Can anybody? I cannot see the screen here. What is the return as per sophisticated we got?
40.49.
40.49 percentage, right? So it means 33.74 percentage of returns, which is less than or equal to, if you see your expected return less than or equal to your expected return on Facebook, okay, is less than equal to 38, or we can say how much we got here. So somewhere your annualized returns lies between these two values. So 1 year returns, if you check the actual return, it will lie between these two range. That's the meaning of why we are getting the difference of this between crude method and sophisticated method. Are you getting this difference here?
So
Yes, sir.
can you repeat this difference again?
Yeah,
Like 33.71 40 between crude and the sophisticated.
yeah. So 33.74 percentage of return, your actual annualized returns can be somewhere between the range of which can be less than your expected return, or which can be less than this expected return can be less than equal to 40, means your returns are lying between this range somewhere.
So this crude and sophisticated is giving me the range between which my expected return may lie.
Yes, yes.
So it can be somewhere between 33 to 40 percentage.
40%. Yes, it can be in your between these two range of line of difference.
Okay.
Got it? Shall we move to the next concept? Do you understand what the concept of crude and what is sophisticated here?
Yes.
Okay. Now, there are many limitations with this average method, but once again, let us try to understand what is the alternate approach for this method. Many, you see, when we do any research papers on specifically, apart from these two methods, also we follow, because this is average method, right? Once again, this is based on your average method only. These two concept. But once again, there are furthermore which are we can say methods which are based on average. That's where the concept of the alternative approach, we can say it's an alternative approach for calculating your historic returns. That's where the concept of moving average will come. Okay. So what is this moving average? This also is something which is very very close to your expected return concept. And who use this moving average? It is a method to calculate expected return only. Many times the technical analysis use this concept of this moving average. Okay. Now in moving average we have many methods, like you take moving average for 7 days, or you take moving average for 30 days. Yes or no? Many, there are 30 days, 40 days, 45 days moving average. So what we do, we average for days. You take average of 7 days, you take average for 30 days. That will give the performance of the stock. Able to understand this one?
Yes.
Now shall we go to our Excel sheet now? Please open Excel sheet. Okay. Now what we'll do, let us see, we'll calculate moving average of date and this returns. What, I'll just copy this one, these two. Okay. Press Control C, copy. Okay, and you plus add this one to new sheet. I'll take it here, just add to the new sheet. Now what I'll do, we'll calculate, let's say there is no specific any days you can calculate moving average, 7 days and 30 days. Okay, all of you please copy and paste in the sheet 2, and we'll check how moving average performance is happening. Okay, we'll do the moving average calculation here. 7 days moving average, 30 days moving average, we'll take it here. Is it over? Shall we?
Yes.
Okay, so this next concept I'm taking here, moving average concept here. That's an alternative method for your historical performance checking of the stock. So here, 7 days means what we'll do, we'll not, as we were discussing, right? There was so much of discussion on this first day whether we should take return or not. We'll take the returns from this particular date, okay, of past 7 days average performance, right? So if I take from this, that's from C3 onwards, okay, the 7 days performance. So tell me till where it will come. So we have to take the 7 days average performance.
C9.
C9, right? So we'll write it here is equal to average. Let's see the performance of 7 days moving average, please calculate everyone, is equal to average 7. So from C3 to C9, 7 days moving average. What is the return?
Yeah.
Is it minus 0.04102? Everyone got?
Yes.
Again, what we'll do, double click. You will get the 7 days moving average answer. If you scroll down completely, just go to the last. This is your returns for 7 days moving average. Past 7 days average performance. So every time what happens, the second day will change from the, yeah, hello, hello. Shall we calculate 30 days now?
Yes.
So let's take 30 days moving average where it will come. What I will do, I'll freeze this one. I will freeze the top row. Go to view. There is something called freeze pen. Freeze the top row. Okay, just freeze this top row. It will easy for me to see the labels of the data. So 30 days means we'll take it from C3. Okay, so from there 30 days we have to take it.
32.
C32, sir.
Yes.
Okay, so this is my 30 days moving average. So I'll calculate here is equal to average, open the bracket, from this value, I'll take it from till this value, close the bracket, 30 days moving average performance. Did you got this one?
Yes.
Now double click this one. So this is 7 days, this is. So what is the common factor where we can consider these values? I think from 2 7. This is where we have all the days of performance written, right?
Yes.
So what I will do now, is it other participant able to do it? Follow me. What I'm doing here, what I did calculation here.
Yes, sir. Yes, sir. Yes, sir.
Okay, what we'll do now, will you just highlight with red color so that there is a uniformity over there. Okay, we'll just take it from that data set. I'll take it from 2nd of July 2012 onwards. Copy that one, and add it in a new sheet, and just to press it here in the A2 you paste it. Okay, sorry, I'll just change it to, this is my date, I guess, right? This is the price, this is the returns, this is your 7 days, and this is your 30 days, right? Just make it ready, this data. Is it ready?
Yes.
Now what I'll do on this date also. Along with date, I am copying here. Mhm. Sorry. Okay. So now I think our data is ready with us. So can we plot this graph now? How can we plot this graph? Date, price, return, and 7 days moving average. Can we? So select these four variables. Control Shift down. Go to Insert. Let's see. Let's see. I'll plot date and these two values I'll plot it. Let me check with date returns. Yeah, you can plot this. Leave the price, date, the returns, and the 7 days return. You just plot this type of graph. I'll just check it with Control X. I'll just go up. Okay, and paste it here. Is the graph is visible? Does it making seven any sense? Return. I take returns versus it's actually 7 days moving average concept here. So these are my returns, actual return, and this is your 7 days moving average returns. Is it clear this graph? So when you're plotting, what are the variables you'll select? Select date, returns, and 7 days returns, average moving average returns. Am I clear?
Yes.
So we can see how there is a next concept will come, the risk calculation, that I'll tell you in this when we start the risk part over here. So how close your daily returns with your 7 days average return, you can see with this graph only. The movement or difference, this one. This is your 7 days moving average model. The same thing what you can do here when you're plotting the graph, you can take the returns with 30 days moving average and check the variation between the actual and the 30 days moving average returns. You'll find the gap, or we can say how much varying the returns between both the days. Okay, is this concept is clear?
Yes, sir.
Right. So this is your analyzed return. So and which is once again we can say uh, there are two, crude method and sophisticated, we discussed. So what is the limitation of mean method or the average return is the expected return whatever we are calculating, no, it is purely depend on the historical informations. So what we can conclude here, from this information. I think sheet 1. What is the limitation of expected return as per the average method is the limitation is that the expected return, or we can say the average return in this method, okay, is purely depend on it's purely depend on historic data, we can say, or we can say historic data, or we can say historic information. So it means the past informations, or we can say past data, based on that only we are calculating my expected return. That's, we can say, one of the limitation of this method. That's why we have many alternate method for calculating the expected return. It's not only the average method, we can say the mean method, but we have, there is a something called as another method, what we were supposed to discuss. That is something called, there the concept of comes state contingent weight probability method. So this is a method which has been derived to calculate expected return. So one was historic average return, the second is state contingent weight probability method. So that method we are going to discuss now, because there is some limitation in historic average method. So we will take it next concept of state contingent weight probability method. So we'll start with the new concept. The second method, okay, which is called as state, to calculate expected return is, the second method is called state contingent, okay, state contingent weighted probability. That's the second method for calculating the expected return. Okay, now question here is, what is state here? Okay, why it is called as state contingent weighted probability method? Here state is nothing but, we are talking about the economy. Okay, it's nothing but economy. And yeah, economy, we can see there are different phases of economy. Like, what are the different phases? The economy can go with phases like recession. Okay, the economy can go with phases like boom. The economy can go with the phases like stable, or we can say normal, right? So basically, these are different state. We call as this. This is first state. This is second state. This is your state, third state. So your economy is passing through different state, and in each state, your expected return will differ, right? So your expected return will be not same in recession, your expected return will not be same in boom, and your expected return will also not be same when the economy is normal. So in each of the cases, we can say the returns are differs. That is why we say state contingent probability method. So here state, we understood it's a type of economy, and for each state there is a probability of getting some returns. So we have to assign some weight for each state. What is the expected return? So we can say weight. So we have to assign the weight for, so that weighted probabilities, we call as weighted probabilities, because the weight of probability should be always equal to 1. So in each state of the economy, what is the weighted probability means, what is the expected return we are going to get it, right? Are you understand what is the concept of this weighted probability return?
Yes.
Okay. Now let's try to understand now this concept with Facebook only. So let's imagine. I'll just show you one. This one. I'll keep it. You can refer one website called as CNN. Okay. This is one website called as CNN. So if you go to in CNN, no, there is a one. You can use this. I'll share the link of this, okay, in chat box. You just please click on that link of the website, edition.cnn. It's a news channel where we get all business informations, business data, everything we get over here. Okay, now what I will do now, you have option called as search ticker here. Okay, now here what we'll do, I'll type the company name here, Meta. Okay, you can type any companies. Okay, let's take Wipro, which becomes very easy for me. Let's see, Wipro is there. Did you click the link first of all, everyone? Did you got this one website?
Yes.
Okay, you just now I search just Wipro ADR. Okay, just for your understanding, I am telling here. If you type any ticker, no, you just have to search with ticker again, name of the company. There is one option called as financial and forecast on my right side. Please check it here. Let's say if I'm clicking on forecast, you look at here, this one. Can you see this one, everyone? Is it visible?
Yes, sir.
Okay, what is state contingency? Okay, this is the Wipro's ADR performance of 1 year stock. 1 year means how much? Past 12 months stocks they have given the performance year, past 12 months. Now here there are three possibilities they have given, right? What is three possibilities? They are trying to forecast the next 12 months. There is a chances of either it can go high, it can go median, or it can go low. Okay, so this is just an forecast. Again, how did they forecast? Based on the past 12 months of data over here. Okay, so if it is high, okay, then the chances of returns will be 24.50 percentage when for the next 12 months. This is called forecasting, we can say. And the next one is how much? Median. Then the chances is how much? 0.51 percentage. If the economy is low, okay, then there is a chances of how much? Negative returns. When we say negative, when there is a chances of low, then the economy is in recession. So let's say that the return we can expect is how much? 15.81, which is negative returns. Okay, are you clear with this concept now, what I'm trying to tell here? So
Oh,
these are three different state conditions of next 12 months they have given. What will be the chances of probability of getting the Wipro's prices for the next 12 months? Am I clear? Is it clear? Shall we go on to discussing what formula we can apply here?
yes.
Yes, sir.
Okay, so you can check with this one. Even in this one also it is available in your Yahoo Finance. If you go to analysis on your left side, there is a something called as analysis. It's a very important website and which has lot of informations over here. Just you go to analysis. Things are very financial. Sorry, here it was in analysis only. You click on analysis, okay, on the left side. You just scroll down. Can you see research analysis? This is you have to just see here. So what is the average stock performance of Wipro is here they given the average. So if it is economy is in suppose let's say boom, then the prices may go to how much? 570. That's a high. Okay, if the average, if the economy is normal average, then it will be 450. If the economy is let's say kind of low recession, then the chances of prices will be how much? 380. Okay, here they have given the prices, but they have not given the percentage of what is the expected return we are, you can get over the next 12 months over here. So this is one way of you can just compare the analysis and find out what will be your expected return for next 12 months. So you can assign weight for this one. Here they have not given, but this website has some kind of, you can say, weight over there. And remember, the weight of should equal to always one. So you can take some, when the economy is very high, you can put more weight or assign there, normal and low. According to that one, you can assign the weight, and based on that you can calculate the expected returns here. Okay, so these two website you can refer simultaneously. One is CNN and one is your Wipro, where you get the forecast for the next 12 months, because expected, right? Because we are talking about expected returns and expected price for the next 12 months. Okay, so for this, how the returns will be calculated, that we will discuss here. That's the second method of discussion. uh, Shall I discuss in 5 minutes? Is it no problem? Can I complete the formula here?
Yes, sir.
Yes, sir, not a problem.
Not a problem. We'll because that formula, if we stop, no, this method will get complete for discussion here. So I'll write here the formula for expected return. The second method, so expected return as per the weighted probability method. Okay. So let's see what is the formula. Expected return, we can say RJ. RJ means the returns of expected return of a J stock is equal to summation of I is equal to 1. Okay. On the top, we will write S. Okay. This is your S. Summation of state RJI into PI. This is the formula to calculate expected return under state contingent weighted probability method. Okay. Now I'll discuss one by one what is this concept of each one. Here, what is S means the state of the economy, whether it's a normal recession or boom, according to that one. So, what is RJI? RJI means the anticipated return or stock J's return. So, we can say RJI means it's your anticipated return, or we can say the stock, any stock. You can take stock J means name of the stock return in state I. Okay, during that economic time, what was the return anticipated, that we should take. Okay, next one is PI. This one we have saw what is RGI, anticipated return or stock J's return during the state of I. What is PI here? PI stands for probability. Okay, it's called as probability of state. Probability of what? The state I, which is occurring, which may or may not be, right? Probability of state I. And WI. S means your, right here, S means the number of possible states, or we can say number of possible states. So in any of the states, okay, any states you can take what is the possibility of getting the market. That's nothing but your state of economy. So this is the abbreviation of this one. We can write this formula like this also. Expected return of RJ is nothing but, we can write as RJ return of J stock at the first state of economy. Okay, into probability, right? Probability of first one plus expected return of J RJ2 into P2, probability of second state, and it will be keep on going. At last we can say RJS into the probability of S. This also can be further written this formula like this. Okay, so it means we need to assign the weight over here. That is very important here to understand this formula. Okay, is it clear?
Yes, sir.
right? So your returns can be calculated, okay, in any of this state. We can use this formula over here for discussion, okay. So it's 8:38. So I'll just stop it here for today. We'll continue with tomorrow. The discussion on CAPM model I'll discuss tomorrow, and we'll start with the risk concept over there with portfolio returns. Okay.
Sure.